In today's video, we are going to talk about option contracts. What are option contracts and how they work? And in later videos, we will dive deeper into contract and we will learn how you can use them into trading. What is an option contract? An option contract is an agreement between two parties to carry out the stock selling or stock buying transaction at a specific price and within specified time period. In stocks, there are mainly two types of contracts. One is used for stock buying, which is called call options, and the other one is used for stock selling, which is called put options. And each contract will have its own terms, like what stock it represents, at what price the stock will be transacted, what will be the time frame in which the contract must be executed, and how many stock each contract represents. In this video, we will talk about US stock options specifically. So in US, each contract represents 100 shares. Now let's look at some of the terminology used in option trading. The creator of a contract is called an option writer. The price at which the stock will be sold or bought, it's called strike price. The duration in which the contract must be executed, it's called option duration. And the last day of that duration is called expiry date. So the expiry date is the last day of that contract. After that day, contract expires and all the terms within the contracts are null and void. Now let's see call and put options in more details. We will start with call option. So what is call option and what it means to buyer and seller of this option? Let's learn this by an example of Joe and Bob. Joe wants to sell a contract of Apple and Bob is looking to buy a contract of Apple. An option, the option writer or a seller, in this case Joe, will decide the terms of the contract. Let's assume that Joe bought 100 shares of Apple at $140 per share. Let's say today is July 7th and Apple stock is trading at $145 per share and Joe decides to sell Apple call, so he will select the terms of this contract. Let's see what it looks like. Number of contract 1, strike price $145, expiration date July 30, 2021, asking price 80 cents per share. This price is also called option price or a premium. Since each contract represents 100 shares, the price of this contract will be $80. So, if Joe is able to sell this contract, he will receive $80 and now he's obligated to sell his shares of Apple at $145 by July 30th if the buyer of this option decides to exercise this contract. Now let's see what happens to Bob, the buyer of this contract. Bob paid $80 to Joe in order to acquire this contract. Now Bob has the right to buy 100 shares of Apple at $145 on or before July 30th. So if Bob decides to exercise this call, he will pay $145 multiplied by 100, total $14,500, and he will receive 100 shares of Apple from Joe. Bob's decision to exercise this contract will depend on the trading price of Apple. So there are two possible scenarios. First one, Apple stock is trading above the strike price of 145, or second, the stock is trading 145 or below. Now, let's see what happens in each scenario. So let's look at the first scenario where the Apple price is higher than the strike price of 145. So let's assume that Apple is trading at $160 per share. In this scenario, it will be profitable for Bob to exercise the call option and get the stock at 145 because he could sell them at 160 and make $15 profit per share. Since the contract is 100 shares, he will make profit of $1,500. And Bob already paid $80 to buy the contract, so his actual profit will be $1,420. So in this case, Bob's $80 investment turns into $1,420. On the other hand, Joe has sold the call with $145 strike, so he will receive $14,500 when the contract is exercised. And he already got $80 for selling the contract. and his initial investment was $14,000. So his total profit in this trade will be $580. If Joe had never sold a call, he could have sold his stock at $160 and he could have made $2,000 profit. So what do we learn from this transaction? There are a few things we can learn from this. First, if you sell the call, you will lose all the upside potential above your strike price. Like Joe, he sold a call at the strike of 145. So if Apple goes to 200 or 300, doesn't matter because he will get only $145 for his shares. So when he sold the call, he put a cap on his maximum profit. On the other hand, the buyer of this call has unlimited gain potential because stock could go up to any price. There is no limit on how high it can go. But he also locked in his buying price at $145. So buyer has unlimited upside potential. Let's look at the second scenario where the stock price is trading below 145. In this case, exercising call will not be profitable for Bob since he could buy the shares straight out from the market below 145. So in this case, if the contract expires and the stock price stays below 145, Bob will lose $80. On the other hand, Joe will be free from his obligation and he will have his shares back. He could do whatever he wants. He could sell them or he could create another contract and sell it to someone else. In summary, buying a call option can provide unlimited upside potential with very low investment, while selling a call option will limit your potential to the selling strike price. Generally, buyers of the call option are speculating that the stock price will go up. In that case, they will make money if the price of the stock goes above the strike price. And the seller of the call option speculate that the stock price will go down or it will stay at the current level. So call selling can also work as an income generating strategy with no risk. If you sell a call and the stock price does not go above the strike price, in that case, the call option will expire worthless and you will keep the premium that you received and you will also keep the stock, which can be used to sell another call option. You can repeat the same process with the same strategy and generate consistent monthly income with selling call option. Now let's talk about put options. What are put options? So buying a put option will give you a right to sell your shares at specific price within option duration. And seller of the put option is obligated to buy the shares at strike price when buyer exercises the put contract. Let's look at an example of Joe and Bob. So Joe owns 100 shares of Apple at $140 per share. Apple is trading at $145 per share today. And Joe buys $140 strike price put option from Bob for $100. So this is how the contract will look. Number of contract 1, strike price $140, expiry date July 30, 2021, premium $1 per share, total cost of contract $100. Now there are two possibilities of price movement for Apple. 1. Apple stays at 140 or above. 2. Apple moves down below 140. So let's look at each scenario and we will see how the trade will perform in each condition. For first scenario, let's assume that Apple is trading at $142. At this price point, it will not be a profitable trade for Joe as he can already sell his shares above $140. So his put option will expire worthless. And in this case, Joe will lose $100 and Bob will profit $100. In other scenario, let's assume that Apple is trading at $137. In this case, exercising the put option will be profitable for Joe as he can sell his shares at $140, which is $3 above the market price. So Joe can make $300 more if he sells his share through put option rather than selling straight into the market. In summary, buyer profits from put options when the strike price is trading below the strike price, and the seller of the put option profits when stock is trading above the strike price. Buying a put option can work as a loss prevention strategy when your stock prices are falling, and selling a put option can also be used as an income generating strategy. Generally, selling a put option will require cash collateral to cover your stock assignment or you need to buy another put option with the similar or later expiry date. Now we know the basic fundamentals of call and put option. Let's look at few more common terminology used in options. First one is ask price. The lowest price the seller is willing to accept, it's called ask price. The next one is bid price. The highest price buyer is willing to pay, it's called bid price. The difference between bid and ask price is called bid-ask spread. So if the seller is asking $1 for the option while the buyer is willing to pay only 70 cents for that option, in that case the bid-ask spread is 30 cents, which is the difference between bid and ask price. And the current price of the option will be the middle price of bid and ask price. So in this case, it will be 85 cents. So when you check option price on your brokerage platform, it will show you three different values. It will show you bid price, ask price, and the current price. Now the current price is not an actual price of the option, but it is a middle ground between bid and ask price. Next term is in the money option. When the strike price of the option is already past the current price, the option becomes in the money. So for call option, any strike that is below current strike price, it's called in the money call option. And for put option, any strike that is above the current stock price, it's called in the money put option. The next one is at the money option. Any option where the strike price is exactly the same as current trading price, it's called at the money option. The third one is out of the money option. For call option, when the strike is above the current trading price, it is called out of the money call option. And for put option, if the strike price is below the current trading price, it is called out of the money put option. There are two more important terms we need to be aware of. It's called intrinsic value and extrinsic value. So the intrinsic value is the amount by which the option is in the money. So let's say if Apple is trading as $145 and you're looking at $140 strike call option, and let's say the option is priced at $5.40. In this case, the option is in the money, so the intrinsic value will be the difference between the strike price and the current price. So it will be $5. And the remaining 40 cents, it's called extrinsic value. Now the extrinsic value goes down as the option gets closer to the expiration date. So the extrinsic value is also called time value. Now let's look at few more examples to understand the intrinsic and extrinsic value, because understanding them is very important in option trading. Let's say Apple is trading at $145 per share and we need to figure out the intrinsic and extrinsic value of following option. The first option is $140 call, selling at $5.50. This option is an in the money option because it's a call option and the strike is below the current trading price. In this case, the intrinsic value is $5, which is the difference of strike price plus the current stock price, and the extrinsic value is 50 cents. The second option is $147 call, priced at 60 cents. For this call option, since the strike price is above the current trading price, this option is out of the money, and all out of the money option has no intrinsic values. So for this option, the intrinsic value will be 0 and the extrinsic value is 60 cents. Now let's look at the sum of the put option. The first put option is $144 put going at 60 cents. This option is out of the money since this is a put option and the strike price is below the current trading price. Since this is OTM, meaning out of the money option, it has no intrinsic value and the 60 cents is the extrinsic value. The second put option is $147 put option going at $2.20. For the second put option, strike is above current trading price, so this option is in the money. And as we have seen earlier, for in the money option, intrinsic value is the difference between the strike and the current price. So the intrinsic value for this option is $2 and extrinsic value is 20 cents. So far in this video, we have covered what are call and put options, how they work, and we also learned some of the basic terminology used in option trading. This covers the basic of options. I'll be uploading more videos about buying and selling options, and I'll be uploading more videos on different strategies used in option trading. Hopefully you will find this video helpful. If you like the content of the video, please give it a thumbs up. If you are interested in stock, finance and money, please subscribe to my channel so you will get notified every time I upload a new video. And I will see you in next video.